Hello and welcome to this Airlie Australian Share Fund update. My name is Mark Jordan from Magellan Investment Partners. And today I'm joined by Deputy Portfolio Managers Joe Wright and Vinay Ranjan. Welcome, gentlemen. Start with you, Joe. It's been it was a wild quarter in investment markets, and that included one of the most volatile reporting seasons we've seen for a while. Can you talk through some of the major moves in the portfolio?
Yeah, no problem. Thanks, Mark. Certainly was a very eventful quarter. And as you mentioned, one of the most volatile reporting seasons on record. I think 20% of ASX companies saw their share price move up or down 10% on the day of their earnings result, which is close to a record, if not a record, from a volatility perspective. But it wasn't just reporting season that was particularly eventful. We saw huge appreciations in commodity prices, notably gold up almost 20%, but also strength in copper, iron ore, rare earths caught a massive bid as well in the period. We had a continuation of this sort of sentiment-driven rally in AI and defense names globally that cascaded down to some ASX companies. Some at the more speculative end, Drone Shield comes to mind. We also had, a plethora of capital raisings, particularly in the resources space, and that's something I think will probably continue given sentiment's turning a lot there. From a portfolio perspective, we saw big share price appreciation in a couple of key holdings, notably, Nick Scali, Charter Hall, Aspen Group, all after really solid earnings results. We also saw a bit of heat come out of CBA. Thankfully, we remain very underweight CBA and think it's quite overvalued. On the other side of the ledger, however, soft results for CSL, EBOS and Hardy's, saw share prices decline pretty dramatically.
And Vinay, Joe just mentioned CSL, and I think it's probably worth focusing on a little bit more there. The share price was down 17% for the quarter. Did you have any conversations with management post that, and what are your views looking forward for CSL?
Yeah, that's right, Mark. CSL was a key detractor during the quarter. When we think about the result itself, the profit result was actually in line with expectations, but it was really the composition of the earnings and the outlook for FY26 which caused investors to panic. And when we talk about the composition, we're really talking about the Behring division, which is the division that sells plasma-derived therapies that CSL's best known for. That division in the second half produced a sales result that was flat year on year. And for context, that's a division that's grown at a double-digit rate probably for the last decade. So it was a bit of a surprise to investors. We did catch up with Paul McKenzie and the broader CSL management team. They offered really two explanations for that soft result. Firstly, the loss of a key contract in the UK, and secondly, the Medicare Part D reforms in the US, which effectively impacted the price CSL receives for some of its therapies. Now, both of those are valid explanations, but the market's really questioning whether the competitors have caught up to CSL and now taking market share, or alternatively, has the IG market moved into oversupply, which is causing some of these competitors to act irrationally. So both would be negative for the share price over a medium term. Where do we stand from a portfolio perspective? Look, the stock's trading on 18.5 times PE. That's as cheap as it's been in the past decade. And we think, speaking to some of the industry contacts and competitors, we think the demand outlook still remains intact, and we think the supply situation is okay. There's obviously some more work to be done, but for the time being, we think it's attractive, and we've added to our position slightly.
Now, it wasn't just reporting season causing all the activity in markets, Joe. The Santos bid fell over. Can you talk about what happened here and what you've done as a result?
Yeah, no problem. So, as a reminder, in June, Santos received a non-binding takeover proposal from the Abu Dhabi National Oil Company, or a consortium that they backed. And the price was about $8.90. The shares lifted pretty quickly to about $8, a 10 or 15% discount to that bid price. And that largely reflected the market's concerns as to whether the deal would complete, the major hurdle being FIRB. we were actually pretty confident that the deal would pass FIRB. As it turned out, it was the consortium that ended up walking away. There's plenty of speculation as to why they walked away. It's all a bit moot now, to be honest. But we actually used that period of share price strength when the bid was still there to rotate our active exposure into Ampol. We basically felt that the shares were trading at a greater discount to intrinsic value, and think the market still continues to underestimate the synergies that will accrue to Ampol as part of the recent acquisition of the EG Group fuel network. So we made that switch, fortunate timing given the deal's now pulled. Again, no major insight into that, but always optimizing the portfolio for the best risk reward.
So we've talked about some of the activity in the existing holdings of the portfolio. In relation to new ideas in the last quarter that have come into the portfolio, perhaps we can give a bit of insight into that.
Yeah, sure. So Guzman y Gomez, or GYG, is a new position we added during the quarter. It's a company we've followed for a while, but felt the valuation was probably a bit too ritzy. We got an opportunity post its result when they issued a pretty soft trading update, and the share price fell quite dramatically. So why do we like GYG? If we step through the investment process, financial strength, they've got no debt and basically 10% of its market cap held in cash. So great balance sheet. From a business quality perspective, what we really care about is the unit economics of the restaurants. And the key metric we look at there is sales per store. So the average GYG restaurant does over 5 million of sales per restaurant. And we think that puts them second to only McDonald's in Australia. Now, the reason that's really important is it allows you to fractionalize some of your fixed costs like rent and labor, and also allows you to bid for those really high quality drive-through sites because you can pay more than some of your competitors. And that creates a bit of a virtuous loop because those AAA sites tend to drive more volume. So we think the business quality is really high. From a management quality perspective, most people would know Stephen Marks as the co-founder of the business. He's done a tremendous job in terms of the food and the menu innovation. But we're also really pleased with the rest of the team. So the chair, Guy Russo, is the former CEO of McDonald's Australia. So we think he's a really key person when you're trying to scale a business from 200 restaurants to potentially 800 or 1,000 over a long period of time. And when it comes to valuation, yes, the multiple still looks very high, but we think you've got to strip out the US losses and really just focus on that Australian business. And if you genuinely believe they can, triple or quadruple the store footprint in Australia, we think the returns look very attractive from here. So, we're very pleased with that investment.
And Joe?
Yeah, thanks. So another holding we invested in the period was Soul Patts, Washington Soul Patts. It's a diversified Australian investment house with investments across listed equities, private equity, credit markets, and property, and also some large strategic stakes in ASX-listed companies. The mandate for this business is effectively to just grow capital consistently and grow dividends to shareholders, and the business has a fantastic track record of doing just that. The catalyst for us to invest in this business was the recent announcement of a merger with Brickworks, which effectively collapsed legacy cross-shareholding between the two businesses and ultimately removed a major governance hurdle for us when it comes to this company. At the same time, we also were able to participate in a liquidity opportunity through an equity raise that was used to partially fund this transaction. Now, why do we like Soul Patts? Well, firstly, as I mentioned, they have a fantastic track record of growing capital and dividends consistently to shareholders. And the secret sauce, within this business is, they have the opportunity to invest with a very long-term horizon and take counter-cyclical approaches to investment. And what that really means is, they've been able to achieve a very attractive return over their history with actually quite a low level of risk taken. Today, the shares are trading at the net tangible asset value backing of the company, which we think really doesn't give any credit for the track record of capital and earnings growth that's been achieved over this company's history. Hence why, we've now taken it to over a 2% active weight in the fund.
Thanks, Joe, and thanks, Vinay. And thank you for watching. If you'd like more information on the Airlie Australian Share Fund, please contact Magellan Investment Partners. And as always, please feel free to share this video with clients or colleagues. Thank you.